Welcome to Real Talk, Indiana's premier talk show on real estate investing, where we talk each week about investing your money right here in Central Indiana. The tips, tricks, do's, and don'ts, brought to you by CIREIA, Central Indiana's oldest and largest real estate investing association. Hello there, my name is Vicki Perry, and I'm the Executive Director of CIREIA. We have over 600 members, all active in or learning how to be active in real estate here in the Indiana market. This radio show is available on FM 95.9, AM 950, podcast on YouTube, and www.cireia.org. Join us each week as we talk about how you can make your money more active with better returns and help the community that you live in with real estate done the right way. Now, on with the show.
Hello, my name is Ron Watson, and I'm the board president for CIREIA, Central Indiana Real Estate Investors Association. Welcome to CIREIA's weekly show where we talk about investing in real estate the right way. It's ups, downs, rewards, and financial gains. We're the largest and oldest nonprofit real estate investment group in the state, and our goal is to help you understand what the opportunities are for you, whether you have a lot of time to invest, minimal time, lots of funds, or minimal funds. Last week we talked about professional property management with Sterling Davis, owner of Ethosity Property Management. If you missed that episode, you can watch it on the CIREIA channel on YouTube or tune in to our website, www.cireia.org, on the calendar of events. Joining us again today is one of the most successful investors in Central Indiana, Brett Snodgrass, broker owner of Simple Wholesaling. Brett and his team did 354 deals last year and runs one of our most successful meetups. Welcome, Brett.
Thanks, Ron. Always a pleasure. Excited for today's show with our guests.
Yeah, sounds good. Also joining us is Matt Crawford, broker, owner of Indianapolis Homes Realty, and Mike Crowder, president of the equity fund related to Homes Realty. Matt and his team have taken real estate into a totally different strategy with crowdfunding and real estate-based equity funds. Welcome, gentlemen.
Good to be here.
Good to be here.
Awesome. Well, I want to get started with Mike and Matt. Love you guys' names, Matt Crawford, Mike Crowder, and so thank you guys for being on the show today. And I'm so excited about today's show because this is a little bit different than I'm used to. So I'm going to learn just as much as anybody listening out there that don't. This is their first time listening to real estate investing. But before we get into all of that, why don't you guys just tell a little bit about how you got into real estate investing, and let's start with your story.
Sure. Yeah, that's a really loaded question with a lot to unpack. But I think the number one thing that I tell people is, I was a real estate agent, still am a real estate agent, and I had a lot of investors coming to me, and they were saying, "Hey, Matt, we want you to find us a real, a rental property or an investment property or something we can make a good return on." And so, that was roughly around the time of the recession, so there was so much inventory on the market. So I would find something that I felt like was a really good investment property, and so I would send it to them, and they would buy it, and they would, sometimes they would come back to me and they would say, "Hey, that property was a horrible property. Why did you send me that property?" And so I would kind of take offense to that and be like, "Man, I think I could have done that myself and done just as good with it." So, after about 3 or 4 times of that happening, I started to say, "Hey, why don't we figure out some way that you can give me your cash? I'll go flip the property and just give you a return." Because when I would walk through the properties after they would say that they didn't make the returns that they thought they should make, I would look at it and I'd be like, "Well, you over improved it, or your labor costs were just, exponentially high." And so, that was the start of what we now have as an equity fund. And so it's heavily regulated, and so I do want to start out by saying, everything I talk about, this is not a solicitation or an offer to invest in our equity fund, just for legal purposes. But yeah, at the end of the day, for us, it was a situation where we had to get an SEC lawyer and form this equity fund and pool people's money together, similar to the crowdfunding, as we were talked about in the very beginning. So when we pooled that money together and we took down properties and we started giving people returns, we were like, wow, we're really on to something. This is something to where we're almost saving our investors from themselves. And, it takes a team of people. And I think that's the problem that most investors didn't realize when they first went into the flipping business, or really the investment business. And so we had that team. We already had the knowledge and we had the labor, especially now, and we'll talk about that here in the future on the show. But we've got our labor costs down to very minimal with how we do our labor. So we have a huge advantage in those areas to really get better returns on properties, and we know where to stop. I think that's the biggest thing that I hear about from real estate investors is, where do I stop when I start to flip a house? So those are all advantages that we've leveraged to help give our investors good returns.
Definitely. Real quick, just to kind of piggyback off that, I'm probably the one that doesn't stop, and that's why I always lose money on all the flips. But so that's why you guys are the experts, and that's why we have you on the show. So cool.
Yeah, Matt, I was just wondering if we take a step back, some of our listeners or many of them may be new to real estate investing. So you talk a little bit more about the crowdfunding term and maybe how that's different from what you're doing?
Yeah, absolutely. Yeah, great question. So crowdfunding, by definition, there is an actual definition, a legal definition through the SEC. And what we do is similar to crowdfunding because we do pool assets together, just like you would in crowdfunding. But we operate through what's called a private placement. And so what that does is it says that we can't essentially take out a billboard and say, hey, come get your 20% returns. So we don't want to cross that regulatory line and break the law by doing that. So with crowdfunding, you can publicly solicit, the problem with that is you can only raise a very small amount of money from each person, like sometimes to the tune of only like $500 from each person. So a lot of times if you're scrolling on Facebook, you'll see several companies that are saying, hey, you can invest in this big apartment building, but you can only a lot of times put in $500 to $1,000, which works for some people. Our minimums are more like $2,500, and our maximum is pretty sky high. I mean, we could take in $10 million tomorrow if we needed to. So we're not limited through our fundraising abilities based off of choosing to be an equity fund versus just straight crowdfunding.
Gotcha. Well, again, this is kind of a new term for me, and I'm going to just kind of dive in because I'm always from just investing, buying a house as a rental property, as a flip with my own money, or I borrow from a bank, or I borrow from Uncle Harry, or whatever. And this is just kind of new. So if someone's interested, why would somebody be interested in this type of investing versus the traditional way that I just described it?
For sure, and I think Mike can touch on that too. But the biggest difference between us, and I think it's a conversation that a listener would have to have with themselves. Are you more of an active investor that wants to manage the product, that wants to kind of manage the people and manage the processes, or are you more of a passive investor where you really want someone else to do those things for you, but you want to still get a return? And so if you are an active investor, you're probably not the right fit for our fund. And there's nothing wrong with that. We still work with active investors. We receive deals all the time from active investors that tried it on their own, weren't successful, and then said, hey, let's partner together to finish this out so I don't totally lose everything. And we also work with wholesalers, and to your credit, some of them have been trained by you. So Brett is who I'm speaking to. So there are active investors that we work with, but when it comes to actually investing in our fund, it has to be obviously that's a vision that is easier to realize than some setups. But at the end of the day, we want someone that is not going to kind of micromanage the process. So when you invest in a fund, essentially you are relying on us to manage that process for you and make sure that we're making the best returns for you as possible. And I'll let Mike kind of talk about how we're structured to incentivize us to obviously get them good returns as far as a preferred return and all that stuff.
Well, we have a team of 7 people. So if I had to be an active investor, which I don't mind being, I have to look at the rehab budget. I have to deal with contractors. I have to negotiate the real estate end of it. There's a lot of components into that. And doing that on my own, I'm capable of doing it, but I'm much happier working with the team because we have a project manager. Go check this project out. We need an accurate budget. And I will admit to you, I may not be the best guy when it comes to construction budgets, but we have someone that will handle that. We have someone dealing with wholesalers like yourselves, trying to find deals. Matt and I have time to go to investors and talk to them about projects we're working on. So if you look at everything that's going on within our fund, we have accounting. I don't have to deal with the day-to-day accounting. Now, I can look at it from a bird's eye view, so I know what's going on, but I don't have to do the nuts and bolts of the accounting. That's not my strength. So we can depend on 7 people, everyone with a clear idea of what they want to do. And so at the end of the day, if everyone does their job, we get through that process a lot quicker and a lot cleaner.
So that makes a lot of sense. I'm just curious, if I were investing and I came to you guys and I said, hey, I want to do a deal. Do I get a menu of deals that you're working on to pick from, or do you help me figure that out, or how does that process work?
Yeah, another great question. So we have an application process. We are exclusive to who we work with. We are, what we do has to be, it's so heavily regulated, we basically have to go through an interview process with you. So we receive an application first to make sure that everything that you're trying to accomplish fits with what we're doing. And if it doesn't, we just tell you. The beautiful thing about what we do is we are very, very diversified in the projects that we do. So it's very rare that we have an issue finding a project for someone. But if someone comes to us and says, hey, I only want to do flips, that's a situation where we would only send them projects that were actual flips. So we would never send them an apartment building that's going to be developed on a raw piece of land. That would just not be the right project for them. If someone comes to us and says, "Hey, we want to really, benefit from the cash flow of a property," well, then we wouldn't put them into a development project, or a flip for that matter. So. We really have an application process where we understand what their goals are and make sure that they fit with what we're doing. And then from there, we have an interview process just to make sure we're 100% on board and understand everything that they want to do. And then we send them deals. And so, I'll kind of let Mike speak to the diversification of our projects and all that.
Well, if someone comes to us and they are looking for a return in 6 months, we're not going to feed them a 3-year development deal. We just had a project over in Franklin Township that we were developing over 60 acres and 100 plus lots with national builders. Great project, a lot of upside, a little bit riskier project, a long-term project, so I'm not going to feed that to someone who wants to get in and out in 6 months. However, if we have new construction or we're going to take a flip maybe down to the studs in a neighborhood like Bates Hendricks, and we think we can be in and out of the project in 4 to 6 months, that's a perfect fit for them. So we're working with, like Matt said, potentially developing raw land for apartments. We look at commercial, small strip centers, office buildings. We've got a lot of different projects that we look at, and some of those range, again, anywhere from 4 to 6 months, maybe 4 to 5 years on the development side.
Well, that's Mike Crowder and Matt Crawford. We're going to take a break, but after we get back, I want to dig into a little bit more detail in how people can actually get involved if they want to reach you guys and where they actually get started in this process. We'll be right back after this. And welcome back to Real Talk. I am Ron Watson, president of the board of directors of CIREIA, and today we're talking with Matt Crawford, owner of Indianapolis Homes Realty, and Mike Crowder, the president of their equity fund. Also joining me is Brett Snodgrass, local investor, coach, and legend. And we talked a little bit before the break about the process of getting involved. And, let's say that my grandmother gave me $10,000 sitting in the bank. I'm dying to do something with it. Can you kind of walk me through the process of, you talked about the application process, but is this something that's going to take me 6 months or 30 days? I really want to get going. Can you kind of walk me through how that might work?
Yeah, so we can invest in a fund within 1 day. We still have to obviously fill out the application, still meet them, understand their goals, or at least have a phone conversation, because we do deal with people that are outside of the state or outside of the area. So we'll do a phone interview as well. We just want to make sure that we totally understand who our investor is and what their goals are, and make sure we're not misleading them in the wrong direction. So The second thing I would say, if you said, "Hey, I've got $10,000," I always talk about diversifying. So any good stockbroker is going to tell you, don't pick one, don't put all your money in one stock. It's the same situation because essentially these are shares of companies. So we set up a company for each project, and then we sell those shares. So that's the whole idea. So I would never say put all $10,000 in one specific project. I would say diversify that into at least 3 to 5. So that'd be my second thing that I would say. But yeah, we can absolutely invest quickly.
When you talk about projects, are you talking about maybe putting some money into a flip, like a short-term gain, and then a development project, kind of like what Mike talked about, longer term?
So if their goal was to only do cash flow, then we would only invest that into 3 different cash flowing projects. It would all be dependent upon what their goal was. But the 3 areas that we really target are short-term, flips, cash flowing properties, and then development properties. So that's going to be your more longer term. So that's kind of the mindset that you'd have to have when you approach it.
Okay. One question I had is, so my grandmother also gave me $10,000.
What a coincidence. That's amazing.
Happy birthday to me. And so, the biggest question about equity funds or crowdfunding is, how am I protected? I know that if I lend a private loan to an investor like Ron, and my collateral is the house, right? Yeah. So I know I'm protected. If he doesn't pay me back, I can maybe get the house. How am I protected with your equity fund?
So it's the same situation. When we purchase a project, whether we're paying cash or whether we're getting a note or a loan or a mortgage, however you want to structure it, we also do creative financing. So when they invest in that business that owns that asset, they essentially own that asset through that business. So that's their protection. They have shares. If the project goes bad, obviously that's never good for anybody, no matter whether they bought it on their own or whether they, and their name's on the title or not. So the worst we've ever had a project go is 13% returns. Obviously we want to keep that going.
It's pretty good.
So yeah, I mean, at the end of the day, it really comes down to the management team. That's the protection. So we never invest in a fund or invest in a project that we don't feel like has multiple exit strategies. So a perfect example is actually Dave Short, who's not here, sold a project to one of our colleagues, and essentially that colleague decided to partner with us on that project. And it's a project that essentially has multiple exit strategies. So it was half developed over in Garfield Park, and essentially it's doubles. So we can either, if the economy goes bad, we can always build them and rent them. If the economy continues to go like it's going, we can build them and sell them. So we've got multiple exit strategies there. We can also just sell the entire project after we have it completely developed or finished being developed. So there's multiple exit strategies, and that's really where the protection comes into play with the 7 people that we have on staff. And I want to touch on that too. We have a compliance officer that makes sure that we're compliant. We have a project manager that makes sure that we're really hammering down on our budgets. And we have several vice presidents, and we have an assistant manager. We have bookkeepers. So all of those people are constantly looking out for our investors, including us, obviously. So, we walk each project. We're very serious about making sure that, that's going to be a good project. And then lastly, and probably most importantly, we always invest our own money into every single project. So if we don't believe in the project, we're not going to put our money into it. And it also comes down to our selection process. So we'll probably look at 20 properties before we'll move on one. And that's the beautiful thing. When people know that we're buyers, people are inundating us with properties, to choose from. And so we have most properties that we have an opportunity to see are not on the market yet. And so we really rule them in or rule them out pretty quickly. And if it's a project that we know is going to make money, and it has to make at least 20% a return on paper, or we don't do the project. That's the minimum. So, those are all the kind of our protection strategies. And I hope that kind of answers the question.
And I want to kind of dive into that because I think that's the biggest question. When I have looked at equity funds or crowdfunding, the return has always been vague. And I know for me, I always like to know, hey, I'm at least going to get in this range. So you talked about your worst return was 13%, and you talked about 20%. And when you talk about 20%, is that everybody getting 20%? And then talk about the past projects that you've done. What is a typical return that people could see? And can you say that on the air?
Yeah, so I would say that every project is different, so I'll qualify it that way. And then secondly, I'll say again, this is not an offer or solicitation to invest in any one of our funds. But at the end of the day, every fund is set up differently. And when you invest in that fund, or when you have an opportunity to invest in that fund, you're going to get a nice little thick document that's been prepared by several attorneys, and it's about 60 pages long, but it discloses and talks about every detail and every aspect of that project. So it also talks about whether we're doing a preferred return or a straight equity deal. And so real quick on a preferred return, that is, it'll say, hey, this has a 13% preferred return, or this has a 20% preferred return. In that structure, then it's basically set up as in legal terms would be called a waterfall. It just means that the investors have to get paid back first, their preferred return, and then the management team would get any money excess of that. So on a straight equity deal, there is no real waterfall, other than whatever the project makes, everybody that's invested in that project splits up all the profit equally. Gotcha. And so those are not, there's a suggested idea of what we think the target return is going to be, but it could go below that or it could go above that. So those are usually why, when you said vague returns, that might be why you've seen vague returns in other people's projects. We generally operate off of a preferred return because it incentivizes us to make sure that project goes good, because we don't make any money unless that project goes well.
Because you have to pay all them first, yeah.
Exactly.
Definitely.
I'm curious, you mentioned this a little bit earlier, but in terms of short-term, long-term, are most of your projects that you're working on, 60-day projects, 90-day projects, or do you have longer projects? I mean, I know it probably varies depending upon what you're doing, but can you talk a little bit more about how that all works?
Yeah, so there's three. I can kind of give you an idea. There's three projects right now that we're actively, raising funds for. And again, this is not a solicitation for that. I'm just explaining to you guys the project. So we've got one deal right now that's 50 some acres, and it's raw land, and it's going to be a long-term project. It's going to be about a $70 million apartment project. So it's not a small project. That would be a situation where we would offer it to accredited investors. And then we just secured 20 properties in Fountain Square, Bates Hendricks. That would be a situation where it'd be more of a shorter term play, whereas the apartments would be obviously a longer term play. So I hope that kind of answers the question. We've got projects of all different kinds.
Yeah. So as an investor, then I can kind of say, okay, here's what I have in mind. Here's what my goals are. Maybe I'm looking to take my grandmother's money and double it in the next 5 years or whatever it is, or hey, I just want to kind of get in and get out and get in and get out and do that 5 times a year, right? So I have the opportunity to talk to you about what my needs are, and you can kind of figure out and point me in the direction of the project that makes the most sense.
Correct. Yeah. So it all comes back down to understanding your goals from the very get-go, and I think that's what separates us from some of our competitors is we really look into what the goal is for our investors, and our investors are our number one priority. So we don't ever want to put them in a deal that they're not going to be happy with. And honestly, that's what's really led us to our retention rates being so high. We've only ever lost one investor, and that's because we actually told them they couldn't be invited back. They
jerk.
Yeah, it was
and Brett's sitting right here too.
Yeah,
so let's
I know,
not-
and that was me.
Yeah,
No, I'm just kidding.
yeah. I mean, it was just a situation, where they wanted to micromanage the project, and he was more of an active investor, and so we just said, hey, you should just be an active investor, and no big deal, but it just doesn't make sense for you to continue to invest in our funds. So.
One last question. When you're talking about long-term projects versus short-term projects, does your returns are higher on long-term or lower on long-term and short-term? Does that matter?
Yeah, I'll let Mike go ahead and answer that.
Well, the returns on long-term versus short-term, it really comes down to the project itself. Long-term projects like development tend to be a bit riskier. So generally speaking, those we'll target a larger return for those. There'll probably be a few exceptions to that, but short-term projects like flips and new builds, in and out time, obviously quicker, risk is a little less. I mean, it's a less risky project, so those would probably be on the lower end of our preferred returns.
Gotcha.
So we're getting ready to come up against another break. We've got a lot more information we want to dig into with you guys, and including the hot seat, which we haven't told them about yet, but that's coming up very soon. So we'll be right back after this information. Welcome back to Real Talk. I am Ron Watson, president of the board of directors of CIREIA, and today we're joined by Matt Crawford, owner of Indianapolis Homes Realty, and Mike Crowder, the president of their equity fund. And also joining me is Brett Snodgrass. So, gentlemen, we were talking a little bit before the break on some kind of technical financial issues. I had a question related to accredited, non-accredited, qualified, non-qualified, all terms that I don't really understand very well. Probably some of our listeners don't either. Could you kind of give us some more information along those lines?
Yeah, absolutely. So there's several qualifying factors for accredited versus non-accredited, but I would say the big three are if you are a single person and you report $200,000 or more adjusted gross income, then you're going to be accredited. If you are reporting under that, then you're going to be non-accredited. If you're married and you have $300,000 or more reported, you're going to be accredited, and if you're under that, you're going to be non-accredited. So that's one gauge. And then the other big gauge, and there's several other ones, but the other big one is if you have a net worth of $1 million or more, then you're going to be accredited versus non-accredited if you're under that. So the beautiful thing about our fund versus majority of our competitors is most of our competitors only work with accredited investors. We do have funds where we work with non-accredited investors as well as accredited investors. So, my heart is with the non-accredited investors because I was a non-accredited investor when I started, my first investment properties. Obviously I'm an accredited investor now, and so obviously we have lots of projects for accredited investors, and we still like to give them good returns, but at the same time we work with both different categories. And then you also use the word qualified. So there's a couple things that would disqualify someone from being able to invest in our fund. The biggest one is basically if you've been convicted of securities fraud, you couldn't work with our fund. So we do have some things that would make someone non-qualified to work with, and that'd probably be the biggest one.
What if you have unpaid traffic tickets?
You can probably you'll probably be all right.
All right.
This is not the confessional booth.
Oh, sorry.
Yeah, it's all right.
I forgot where we were. Hey, I just wanted to, a lot of our listeners out there, they have 401ks, IRAs. I know my parents have that, and they're typically investing in stocks, mutual funds, some traditional way of investing, right? And I know when I first got married to my wife, she had inherited some stocks, and we still have those, and I'm still investing in mutual funds. And when you talk about your returns, that's pretty good. So can you kind of tell our audience and compare what are the benefits of investing in your equity fund or any equity fund in a real estate versus the traditional route of investing in mutual funds or stocks and whatnot?
Yeah, I'll let Mike touch on that.
Well, if you're investing in stocks or even a REIT, which is real estate centric, you can't really go out and touch the property. You can't touch the asset. You can't feel it. If you invest with us in real estate, we're going to have a development project. You can go look at the land. You can see the flip we're working on. You can go check the progress. It's tangible. It's something you can touch and feel. And it's not just a paper asset. So I think this gives the investors hopefully a little bit more diversification when you're investing in real estate. But again, it's just something that you can feel and touch and see on a day-to-day and not just be dependent on, well, I hope they get that statement in 3 months and let's see where the mutual fund is.
Yeah, I mean, I don't understand any of my statements, so that makes sense. That's cool. That's awesome. That's good. Yeah, and just kind of again, I don't even know what are the typical returns for stocks and what people are getting now, and then kind of just go over what you guys are seeing in your equity fund right now again.
Yeah, so I can't really speak to what a typical return in the stock market is for real estate REITs. I can say that I've seen them somewhere between 8 and 10%, sometimes 12. The lowest that we usually go in our funds is an 8% preferred return, and there's usually going to be some type of back end kicker where they can make above that 8% if we do that, and then the highest that we usually do on a preferred return is a 20% preferred return. So, I don't generally see that in the stock market or mutual funds. I would say that there is a difference, though, and it might be a strike against us in the respect that, our funds are more illiquid than a mutual fund or a stock, so our funds are not publicly traded. So you can't, there's no publicly traded market for our funds.
Can't just click a button and sell it.
Correct.
Right.
Yeah. So when people come into our fund, they're usually committed. There are situations and there are verbiage inside of our operating agreements that allow people to sell their shares, but they usually have to sell the shares to people that are already in the fund first, and then if no one buys them, then they can sell them to someone else. But again, they would need to find that person. They couldn't just go to the stock market and publicly trade them. So but at the same time, it comes down to whether you want to actually know what you're investing in or not. And that's a big thing with 99% of our investors is they love the fact that they can go walk through a property and say, hey, this is a good property.
One quick question on that. That's thank you so much for the advice on that. So if someone has some money tied up in an IRA, can they invest straight out of their IRA into your equity fund? Because I know that's a question. Do they have to sell off the IRA or their stocks in order to invest in your guys's?
Yeah.
fund?
So about 50% of our investors invest into our funds through either a self-directed 401k or a self-directed IRA. And I think the tax advantages of those are amazing. So I think it's a no-brainer. But at the same time, some people set up a company and then they buy shares of our company with their company. So that is an option as well. It's really comes down to however you're doing your tax planning, and some people like to pay taxes and out of the way up front, and some people don't. So.
Nobody that I know
Yeah.
pay taxes, but
Except for Ron.
I just can't get enough. But let me ask you, as the president of CIREIA, I always like to get back into your involvement with CIREIA and,
Sure.
and how people can communicate with you. I know you have a subgroup. Maybe you can talk a little bit about what that is and what you guys do there. And I know you also have a class coming up in April, so maybe another way for people to get to know you guys a little bit more. So can you talk about those things for us a little bit?
Yeah, so Mike and I head up a subgroup with CIREIA called Passive Investing. So if you didn't get all your answers to your questions today, you can absolutely come to one of our passive subgroups. And we are very transparent and we answer tons of questions. And, it's a great time to learn about all the different passive investment opportunities and also learn more about the equity fund division of our company. And then we actually have a conference, if you will. I guess that's probably the right way to say it. Coming up in July, and so that's going to be our very detailed version of all the things that we do to analyze a property. You can see how we break down and really assess the risks of a property, and you can really understand how we structure our funds and why we structure them the way that we structure them.
So the again, as a CIREIA president, I got to put another plug in for us. But the subgroup is we have many subgroups in CIREIA, and it's a small group typically. How many people do you usually get in your subgroup?
Yeah, so I'd say we probably have 15 to 25 people. Sometimes we have standing room only, and I think we've had as many as 50 people in there at one time.
Wow.
We try to keep it somewhat small because there's a lot to unpack inside of passive investing, and it's a really attractive thing right now. A lot of people like the idea of putting money into something and not having to think about it and just getting a return. Who wouldn't, right?
Exactly. Where do you meet with your subgroup?
We meet at our Indianapolis Homes Realty's headquarters, which is 6004 Southeast Street. So basically Edgewood and 31 on the south side of Indianapolis, right off of 465 and 31.
And did you say how often that meets, and is it once a month or?
Yep, once a month on the third Thursday. So.
Fourth Thursday
Oh,
of
fourth
every month.
Thursday.
That was the president. He knows.
There you go.
I think. So that's
keeping me on
probably
track,
more
yeah.
accurate information there.
But Matt will be there on the third Thursday in case you have extra questions.
All right, well, he'll just be sitting there.
One-on-one.
Well, I know that you can also find out more information about all of our subgroups on the CIREIA website, www.cirea.org. And so all those that information is listed there as well. And coming up after this break, I hope you guys are ready. Get your water out. We've got the hot seat coming up. Brett and I have been working on this for quite a while, so we're ready to
I'm
go.
excited.
So we'll be back right after this. Welcome back to Real Talk. I am Ron Watson, President of the Board of Directors of CIREIA. And today we're joined by Matt Crawford, owner of Indianapolis Homes Realty, and Mike Crowder, the president of their equity fund, and also Brett Snodgrass. Now we're coming to the hot seat segment of the program, and I know Brett has one to lead us off, so go ahead, Brett.
Definitely. I'm always so excited for the hot seat. You guys ready?
I'm ready.
All right. So I know some of the questions that we've had come in is, what are the costs and fees associated with an investor coming into your equity fund?
Absolutely. So we charge a 2% management fee. That does not come out of the preferred return, though. So if we say it's got a 15% preferred return, that's what the preferred return is. So that's another reason why we set up preferred returns as opposed to straight equity deals most of the time. It's just more fair. And if it's a straight equity deal, the 2% comes out of the profits, and then whatever profits are left gets split up amongst the investors.
So how do you guys make money then? Is it based on those fees, or is there more money that you're getting that we haven't really talked about yet?
Sure, yeah. So when it comes to the preferred return, if we say a project has a 15% preferred return, but then it makes 30%, we keep that extra percentage. So that's how we would make money on a preferred return. If it's a straight equity deal, a lot of times we build in a management fee, obviously, of the 2%, but we might also say, hey, because this is a development deal, we're going to handle the development and be paid to do so. So all of those things have to be transparent and disclosed inside of the actual private placement that we give investors. So it's all 100% transparent. Everybody sees what's happening.
However, if we make 15% on that deal, Mike and Matt and our equity fund make 0%.
And that's correct. Yeah. So we've had on a 13% deal, we made no money, but our investors still made 13%. So
Wow.
That is a possible scenario. But at the same time, we've also had deals that were straight equity deals that made 70% returns. And
Wow.
so there's all different scenarios. But our biggest thing is, if we say it's a preferred return of X amount, that's what is going to the investor.
So important. I think that's why you guys are so successful, been around for so long, that you're always sticking to your word and treating your investors, other people's money, more important than yourself. So I want to get your opinion. Cash flow or flip? What do you prefer?
So, that's Mike and I differ on this so much. So
That's a loaded question.
It is a very loaded question.
It is the hot seat.
It is the hot seat.
Thank
So my personal opinion is I don't like to be in a project more than 2 to 3 years because I don't feel like I can see that far ahead. And it's even hard to see 2 to 3 years ahead. But most of the time when I look at from a macroeconomic standpoint, I feel like I can see out 2 to 3 years pretty fairly. And most of my predictions are pretty accurate. So with that being said, I like the idea of going into a project and really truly developing it because there's more meat on the bone usually when you're developing versus a flip. A lot of times we do flips and new builds kind of simultaneously. They're pretty much the same returns. A little bit less risk on a new build because you know exactly what you're getting into versus a flip. So those usually have lower returns. I like to go after bigger returns, so I like development deals myself.
Cool.
All right, so we talked about some good things that can happen and some very good returns. Can you share with us, has there ever been a deal that didn't go so well?
Yeah. There's been several deals that didn't go so well. So, when we secure a deal, we never know what's going to happen, but we use our own money to secure deals. So this is another way that we shield the investors. We don't ever send out a private placement on a deal until we fully have vetted that deal. But we, at the same time, have to move fast in the real estate market, especially that we're in now with low inventory. So, we tie up properties a lot of times with our own cash, and then we start to really dive into the numbers and get the information. So the deals that have gone bad 90% of the time are deals that we have not even pitched to investors yet, but it's with our own money at risk. So perfect example. There's 60 acres behind my house. There's a really long story to it. But essentially, when I bought my house, I was told, this farmer is never going to sell this land, and so I look out over the cornfield, and I'd be like, man, this is great, And so, of course, unfortunately, the farmer passed away, and he was a really good guy. But his kids were like, hey, you know what? We don't want to farm the land, and I totally understand that. So it went on the market immediately, and within the first day there was 6 offers. And so I said, hey, I want to secure this land. I want to control what goes behind my house. We live in a custom neighborhood, and I don't want a low end builder to go back there. So we tied up the land, $100,000 out of our pocket as earnest money. We started diving into it. The developer that we thought we had that was going to be a partner with us did not pan out the way that we thought that he would. And so here we are with a very short amount of time left on our due diligence period to close on this land. And we had to scramble and find the right developer partners. And actually, Dave Short came in really handy on that and helped us connect the right people. And that's a credit to CIREIA, because without that connection, we would have not completed that project. And so we got connected with the right developers. It ended up panning out really well. But then right before closing, about 2 weeks before closing, one of our big investors said, hey, you know what? I only want to put in $1 million instead of $2 million into this project. So within a week and a half, we had to raise $1 million. It ended up working out okay, but I'm telling you, we were stressing because that $100,000 in earnest money was going to be gone, and so was all of our basically another $100,000 in engineering and legal fees and zoning and all that stuff was already spent. So we were about $200,000 into that project that very easily could have went really bad.
So, of course, you could have always just been a farmer, but I guess you decided to go a different direction.
It would have been some real expensive farmland.
Are you just focusing on deals in Indianapolis and Indiana? I mean, in central Indiana, kind of what's your range?
So I'm a Hoosier at heart. I'm born and raised in Indianapolis. Mike is the same. My dad was in construction. He worked for a bigger company downtown. If you go to St. Elmo's, you can look in the bricks. My name's in the bricks because my dad, helped, repair and everything, St. Elmo's and make it what it was. So, I'm very tied to Indianapolis. My name is literally on the city. So pretty much every project that we do is in Indianapolis and the surrounding areas because I want to physically touch that project. I want to walk through it. I want to understand everything, and I'll let Mike speak for himself on that.
Well, yeah, we just typically invest within the donut. And for all the aforementioned reasons, investors know where the projects are. Most of our CIREIA contacts live within 30 to 40 minutes, I would say, of any of our projects. So it's very easy for them to get familiar, know what we're doing, and it just shields everyone.
Well, gentlemen, believe it or not, we're about out of time. I did want to give you guys an opportunity to share with the listeners how they can reach you. And if you have a tip of the week before we wrap it up, that would be good as well.
Absolutely. So you can reach me, usually Matt at IndianapolisHomesRealty.com. Email is usually best for me. You can also text me or call me at 317-908-2309.
And I am at Mike at IndianapolisHomesRealty.com. You can reach me 317-698-1107. And Ron, I would like to also thank your grandmother who just texted me, and she said she had 20,000, not 10,000. So
She lied.
Yeah.
That's another show altogether. So
Tip of the week, I would say, just before we wrap up, tip of the week, if you are an active investor versus a passive investor, there is a big difference between 10% as an active investor or 10% as a passive investor. So my tip is to count your labor cost. If you are actively flipping a property and you're not calculating in the cost of your time, you're doing yourself a disservice. So if you make 10% return flipping a property, but you never calculated in the amount of time that you spent on that property versus a 10% return as a passive investor who has zero time in that property, you're going to come out way more ahead on the passive side versus the active side.
Well, thank you very much, gentlemen. I wanted to thank Matt, Mike, and Brett for joining us today. We also wanted to just say that we have a special event at the end of the month with CIREIA Tuesday, March 27th. It's sponsored by Atlanta Mortgage, and Longhorn Investment Commercial Lending. They'll host 2 sessions to learn about what you need to know when borrowing money for your investments. Also, please join us on April 5th at our next main meeting, where we have a landlord panel. And don't forget that Matt teaches a monthly subgroup for CIREIA about passive investing and will be hosting an all-day event in July. Find out more about our group and our events at www.cireia.org. Thanks again, Brett, Matt, and Mike.
Thank you.
Thank you.